For the first time since 2012, home prices across the United States have moved into negative territory on a year-over-year basis. The decline measured 0.2% compared to the same period 1 year earlier. That figure comes from the country's broadest national housing price index, released only weeks ago. The Housing Center at the American Enterprise Institute is warning of a deeper downturn ahead. According to projections from the group, by the end of 2026, single-family home values could close the year about 1% below where they began. In some outcomes tied to mortgage rates and employment conditions, the decline could extend to 2%. Across 39 of the 129 largest metro areas in America, prices already dropped during the first quarter of 2026. Cape Coral and Fort Myers posted declines of 9% from a year earlier. Austin also moved downward. Several California metro regions have reversed course as well. Markets like Ocala, Lakeland, and Naples, which once led the pandemic housing surge, are now among the fastest declining. This marks the opening stage of the first prolonged national home price contraction since the financial collapse of 2008. The importance of this moment becomes clearer when placed in context. In February of 2026, First American Data Analytics released its National Home Price Index. Chief economist Mark Fleming stated that annual home price growth had slipped slightly below zero, falling 0.15% from 1 year earlier. It was the first yearly decline recorded since 2012. The February data showed no monthly movement and a year-over-year decline of 0.2%. Before that reading, annual appreciation had stayed below 1% for 7 straight months. It became the longest stretch of near-flat growth since the index was launched in 2012. The Housing Center at the American Enterprise Institute released an even darker outlook. Co-directors Ed Pinto and Tobias Peter published April figures showing the national trend already turning negative during the first 3 weeks of that month. Their forecast for the full year of 2026 projected that single-family houses would end the year roughly 1% below their starting point. Under weaker mortgage and labor conditions, the decline could deepen to 2% by December. The financial impact on homeowners is substantial. The median home value in the United States currently stands near $4,700, according to recent national estimates. A decline of 1% translates into nearly $40 in lost equity every year. A 2% decline pushes that figure above $8,000. For owners who purchased during the pandemic peak, when median prices climbed to around $44,000 in mid-2022, those losses compound on top of equity gains that were never fully secured. The downturn is not spread evenly across the country. The losses are centered in 2 major categories of housing markets, and together they represent a large portion of American real estate. The first group includes the pandemic boom regions. The second involves areas where insurance costs have become financially unmanageable. During the years from 2020 through 2022, Sunbelt markets experienced massive migration inflows. States like Florida, Texas, Arizona, Nevada, along with parts of inland California, attracted large numbers of residents leaving expensive coastal cities. Remote work allowed many Americans to relocate into lower-cost metro areas. Prices exploded during that period. In Cape Coral and Fort Myers, values surged roughly 70% between 2019 and the peak in 2022. Austin climbed more than 60%. Phoenix, Las Vegas, and multiple Florida cities also experienced extreme appreciation disconnected from local wage growth. That boom was powered by extremely cheap borrowing costs. Mortgage rates between 2.5% and 3.5% made even inflated home prices appear affordable on a monthly payment basis. Once rates climbed into the range of 6% to 7%, the math changed completely. A house priced at $4,000 with a mortgage rate of 2.8% carried an estimated payment near $1,648 per month. At the same purchase price, but with a 6.5% mortgage rate, the monthly payment jumped to approximately $2,428. That represents an increase of $880 every month on the exact same property. The monthly ownership cost rose by 53%, while the asset itself remained unchanged. Markets that depended on pandemic-level affordability combined with pandemic-era interest rates are now structurally overvalued under the higher rate system that replaced them. Those markets are now correcting downward. Florida faces another pressure beyond mortgage rates alone. Hurricane destruction has pushed insurance costs sharply higher, leaving many homes effectively impossible to insure at practical prices. When a house becomes impossible to insure, when insurance companies refuse to issue affordable coverage, that property can no longer qualify for a standard mortgage loan. Once financing disappears, only cash buyers remain in the market. The pool of all cash purchasers is dramatically smaller than the number of buyers using loans. Because of that imbalance, prices must decline until inventory reaches levels cash buyers are willing to pay. A participant in Florida's housing market named Oops described the situation clearly. When a home turns uninsurable after hurricane damage, the value does not slip slightly. The reduction becomes severe. Florida now faces two separate pressures at once. Mortgage affordability has been crushed by higher interest rates, while insurance costs are blocking financing access altogether. Together, those conditions are forming a perfect storm inside the state. That helps explain why Florida represents such a large share of the 39 metro regions already showing declines. The broader national situation depends on whether the current 0.2% decline marks the bottom or only the opening stage. Mortgage applications dropped almost 11% during a single week in May of 2026 as rates climbed back towards 6.5% after oil prices surged during the Iran war. Sales of newly built single-family homes fell nearly 18% in January compared to the previous month. They are also down 11.3% from 1 year earlier. Existing home transactions, the foundation of the housing market, remain close to the lowest level seen in 30 years. Millions of owners who secured mortgages between 2.5% and 3% during the pandemic period refused to sell because doing so would mean surrendering those rates. That mortgage lock effect has frozen available supply for the past 2 years. Housing inventory is now increasing sharply year over year in the regions, experiencing the heaviest downward pressure. But the rise is not happening because homeowners suddenly want to sell at current prices. The increase is coming from people forced into the market through job transfers, divorce, financial pressure, or estate liquidation. Those sellers must accept market clearing prices regardless of their expectations. That motivated inventory is now competing against a buyer base smaller and more price conscious than at any time since 2012. The 7 consecutive months of national appreciation below 1% before February's negative reading were not random fluctuations. They were a warning sign. Ed Pinto stated directly that by the end of 2026, national trends would move below zero, with certain markets falling 2%. The first annual national decline since 2012 may not represent the end of the story. It could instead become the headline that marks the start of a broader slide. National housing prices have already turned negative year over year for the first time since 2012. The American Enterprise Institute projects full year 2026 declines between negative 1% and negative 2%. 39 major cities recorded declines during the first quarter. Cape Coral and Fort Myers dropped 9%. Florida, Texas, Arizona, and California are leading the downturn. Millions of existing owners remain trapped by low mortgage rates from earlier years. First-time buyers are increasingly locked out by affordability conditions. Coastal properties continue losing value because insurance costs keep climbing. All of these developments are measurable, current, and accelerating. The next question is whether this remains a manageable correction or evolves into the first prolonged nationwide housing decline since the Great Financial Crisis. One of the least discussed indicators in the housing market is foreclosure activity. During October of 2025, the United States recorded 3,661 foreclosure filings nationwide. That represented a 19% increase from the same period 1 year earlier. Those numbers are nowhere near the scale of 2008. During that crisis, the country experienced 3,100 foreclosure filings within a single year. The present situation is different, but the direction matters. A 19% annual rise in foreclosures, while unemployment remains relatively stable and mortgage delinquency levels stay historically low, signals stress building beneath the surface. These are not the subprime borrowers from 2007. The current cases involve homeowners who purchased near the market peak in 2022 using conventional loans. Many expected continued appreciation and stronger equity positions. Instead, they are confronting rising insurance premiums, higher property taxes, and, in some cases, economic disruptions tied to the Iran war. The geographic pattern of foreclosure growth matches the areas already experiencing falling prices: Florida, Texas, and Arizona. The same regions that dominated the pandemic housing surge are now leading the distress cycle. This is not accidental. It is the mathematical outcome of purchasing at peak valuations, financing under higher rate conditions, and holding assets in markets where prices are now declining rather than climbing. The housing market of 2026 is fundamentally different from the market that existed during 2008. That distinction is critical. The crash in 2008 emerged from systemic financial fraud. Subprime loans were issued to borrowers who could not qualify under normal standards. Those mortgages were then bundled into financial securities that few investors fully understood and distributed throughout the global banking system. When defaults spread through the market, major financial institutions became insolvent at the same time. Losses remained hidden because the structure of the securities concealed the underlying risk. The housing system today does not operate under that same structure. Most property owners purchased homes using conventional loans, verified income, and substantial equity positions. Mortgage delinquency levels remain near historic lows. Banks are no longer carrying the same off-balance sheet mortgage exposure that existed in 2007. The financial weakness that transformed a housing downturn into a worldwide banking collapse during 2008 does not exist in the same structure today. Jake Krimmel explained the stabilizing force inside the current market. The mortgage rate, lock-keeping millions of homeowners tied to 2% through 4% loans, is also acting as support beneath prices in many regions. Because those owners refuse to sell at current conditions, inventory cannot suddenly flood the market all at once. Unlike 2008, when distressed selling overwhelmed housing supply, today's locked-in owners are mostly remaining in place rather than dumping properties at any available price. At the same time, the Midwest and Northeast continue posting gains. Those increases are becoming an important balance against the declines hitting the Sun Belt. Cleveland led all major metro areas with annual appreciation of 4.5%. During 2025, Hartford recorded 4.4%. Milwaukee reached 4%. Buffalo and Chicago both posted 3.7%. These cities never experienced the same pandemic-era price explosion seen elsewhere. Because they remained relatively affordable, they are now attracting buyers pushed out of coastal and Sun Belt markets. The national average decline hides a real divide inside the housing system. America is operating with two separate housing markets moving in opposite directions. There is also a deeper demographic trend shaping the medium-term outlook, and it carries more weight than any single year of price movement. By the middle of 2025, approximately 6% of Americans struggling with housing costs had moved back in with parents. Another 6% began sharing housing with roommates. Those numbers are expected to climb further through 2026. Home ownership rates among Gen Z and millennials have stopped growing. Many younger households are no longer simply delaying purchases. They are changing family formation decisions entirely because housing expenses have become too high. The national fertility rate has already been declining gradually for years, and forecasts expect that trend to continue as rising ownership costs push younger Americans further away from the household formation cycle that normally drives housing demand. At current mortgage levels, buyers need to earn nearly $35,000 more annually than renters just to cross the affordability threshold for a median-priced home. This is not a short-term disruption. It is a structural imbalance between wages and prices. Corrections of that scale typically require years through either major price declines, meaningful wage growth, or substantial reductions in mortgage rates. Right now, none of those three conditions exist at the level needed to rapidly restore affordability. The Iran war energy shock is also complicating the interest rate outlook. Professional forecasters are projecting CPI at 6% during this quarter. When the new Federal Reserve chair was sworn in, the first remarks focused on independence and resolve rather than rate reductions. Market pricing currently reflects a 61% probability of another rate hike before the end of the year. If rates move higher in this environment, mortgage levels could approach 7% instead of 6%. Every increase of 25 basis points on a 30-year mortgage from current levels adds roughly $60 to $70 per month to payments on a median-priced home. At a 7% mortgage rate, the payment on a $4,000 property with a standard down payment approaches $2,660 each month. That level exceeds what many American households can sustainably dedicate to housing expenses. The housing market is now experiencing what one analyst described as a silent recession. Not the dramatic collapse visible during 2008, but a slow deterioration in vulnerable regions. Transaction volume across the nation remains frozen while affordability barriers continue reshaping household behavior year after year. Younger Americans are staying with parents longer. Family formation is being postponed. Homeownership is increasingly delayed without a clear timeline. The negative national housing reading in 2026 is the statistical confirmation of a reality millions of Americans have already lived through for the past 3 years. For homeowners in Sunbelt regions that led the pandemic boom, the correction is real, measurable, and projected by the American Enterprise Institute to continue through 2026 with declines between 1% and 2%. For homeowners in the Midwest and Northeast, conditions remain stronger. Many of those markets are either stable or still rising because affordability remains more favorable. For first-time buyers waiting for accessibility to improve, the data now shows two opposing forces at once. Prices are finally softening, but the possibility of rising rates threatens to offset much of that affordability improvement. The housing market entering 2026 is no longer operating under the assumptions that defined the pandemic boom years. The adjustment is already underway, and the numbers are beginning to confirm it across the country. Follow for more updates on housing, economic pressure, and the financial shifts reshaping American households. Share which city you are watching most closely and how conditions are changing in your local market. Please leave your thoughts about this content in the comments below. Thanks for watching. See you in the next one.